So we get started with the monetary policy. With NXM, there are two functions in the math that we want to talk about. And as you can see, this formula over here. Now, that is the formula for determining the price of NXM token. And there are two variables in there. So there are two variables that's fixed and two variables that's flexible. And I'm going to circle the fixed one out, and I'm going to underline the variables out. So you could see that A and C are fixed variables, and we're going to dive into that a bit deeper anyway. And then the thing that changes is the MCR and this other thing called the total capital or capital pool. These two variables are important because what do they signify? If we look at MCR, MCR is kind of like the reserve in a bank. Have you heard of fractional reserve? So if I put $100 in my bank, the bank will, by some laws of the government, it's changing a bit in 2020, but let's just say that the government says that you have to take 20% of your deposit, the bank has to take 20% of deposits and put it in the bank as a reserve. So if I put $100 in the bank, $20 will be in the reserve that the bank cannot touch, and the rest of the $80 can be used to be lent out to other people. So that's fractional banking, that's fractional reserve. NXM does something similar. So if I put $100 ETH as capital into the NXM pool, part of it has to go to reserve and the other part is available. So that's the general idea. And that's what MCR is. MCR is the minimum capital requirement. It's kind of like the reserve in the bank. The second part is the total capital or the capital pool. And if you want, just now we talk about market design and how NXM is quite related to the DeFi market growth or the DeFi growth. So the total capital increase, you can think about it as the increase in DeFi adoption or DeFi market adoption, DeFi protocol adoption. So as more DeFi protocols are being adopted, you can argue that there's a correlation to an increase in the total capital. So these are two variables that is included or that is involved in this model. And this is very important. Why? Because MCR, so the reserve in the bank, is like a short-term forecast or short-term variable to understanding the growth of Nexus Mutual's protocol. Whereas the total capital, this variable, is a way to look at the long-term growth of Nexus Mutual. Really cool, right? Because we're looking at this formula where it involves both short-term variable and long-term variable. Again, short-term variable because these are amount of money or reserve that you could use to do your insurance cover, whereas the long-term growth is the total capital, which is linked to DeFi adoption. How cool is that? And because of that, we're going to look at three elements in the bonding curve. The first one, as you can imagine, is the total capital. The second is the MCR, so the capital requirement. And this capital requirement is important. So in case anything happens, this minimum capital can be used to cover the insurance. And lastly, it's the MCR ratio. So the ratio, because we only have two variables, right? The MCR and the total capital. So the MCR ratio is it's the total capital divided by MCR. So the linking between these two variables. So MCR is the short-term growth, total capital is the long-term growth, and then we're going to look at the interrelation with them, and then we have these three different variables added into the model so that the model can give us a more robust understanding of the entire ecosystem through the price of NXM token. Make sense? The price of NXM token is very cool because it's not only just giving you the value of what NXM, the system does, but it also takes in the short-term growth, the long-term growth, and the relationship between the short-term and long-term growth. And that's why NXM is very interesting. Let's look a little bit deeper at the bonding curve. As I mentioned, this is the formula. So the price in everything is based in Ether. So the price of the NXM token is A, which is A and C are two fixed amount. And then the MCR also priced in ETH. It's the minimum amount of capital required to cover the existing covers. And this is, so they of course we're looking at, the minimum capital requirement, you could use 100% of the capital that is added into the system to be used as the minimum capital requirement so that people can be always covered, right? You're always assured. But at the same time, if you think about it, that's quite inefficient use of capital, because this capital is, I know it's insurance, right? And the thing about insurance is that everything you insure, it doesn't always happen. Like the bad things don't always happen. So you just buy insurance as a hedge. And if these things don't happen, but you still have your capital sitting there, just preparing in case these bad things happen so that the insurance, the capital could cover it, then it's a very inefficient use of capital. So they've done some calculations to see what's the probability of bad things happening. So what's the minimum capital required to cover these bad things? Like this minimum level of bad things. So we call them the minimum capital requirement, MCR. And then you have your MCR percentage ratio. So that is the capital pool divided by the MCR. So the capital pool is the total amount of collaterals in the pool. If you think about it, if you are very comfortable with AMMs and decentralized exchange, capital pool is kind of like a liquidity provider. You have this big pool, and then you just provide your capital inside. And in AMMs, that's where people can be swapping and trading and doing your exchange. Similar concept where you have a big pool, and then you put ETH in there to get your NXM token out. So it's a similar concept. So that's what total capital is. Total capital is something like a liquidity provider or liquidity pool. Then the capital requirement is the minimum amount of money required to pay the claims. Let's say 1% of all the claims are defaulted and you have to pay out. And that is what the minimum capital requirement is. That's how you get it. And the ratio is capital efficiency. It shows capital efficiency. So you have the capital divided by the total capital divided by the requirement. So it's how efficient your capital is being used. Remember, if I take 100% of the capital or the total capital and I put it store in my safe, so just in case any bad thing happens, then we are always assured that there is enough money to repay. That's good, right? But if nothing happens and you know that you're 99% sure that out of this 100 ETH that's in the pool, 0.001% is going to be pretty safe. Or it's going to be really safe. And so we want to take this 0.001 ETH out and use it somewhere else. So maybe you can use it in other kind of system to be getting returns. And that is efficiently employing capital. We talked about this in one of the first few slides in the previous video of how insurance is such a big market, because they aggregate risk from everyone. But the thing is, not everything will happen, not all the bad things that they cover in insurance will happen. So then they have this pool of capital available because people are buying risk, right? And some people are super risk averse. So people will be paying more. And because of that, insurance companies can use this capital available, and reinvest it somewhere else so that they can be earning more money. And this is why the MCR ratio is quite important, because it talks about capital efficiency. How efficiently is capital being used and deployed in the system?